Have you ever wondered why investing in stocks is so important for our livelihood? It's a question that many of us ponder. Well, let's dive right into it. Investing in stocks is like planting seeds for a financially secure future. When you invest in a company's stock, you're buying a piece of that company, becoming a shareholder. As the company grows and thrives, so does your investment. It's a way to put your money to work rather than letting it sit idle in a bank account. Now, don't get me wrong, investing in stocks isn't a get-rich-quick scheme. It's a long-term commitment. And it's not without its risks. But the potential rewards can be substantial. One of the key benefits of investing in stocks is the potential for high returns. Historically, stocks have offered much higher returns than less risky assets like bonds or savings accounts. Over the long term, the stock market has an annual average return of around 7 to 8%. That's a pretty attractive rate of return, wouldn't you agree? But it's not just about the potential for high returns. Investing in stocks can also help you beat inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. By investing in stocks, you can potentially earn returns that outpace inflation, preserving the purchasing power of your money. Now let's talk about value investing, a strategy famously used by one of the world's most successful investors, Warren Buffett. Value investing involves buying stocks that appear to be undervalued by the market. It's like buying a dollar for 50 cents. The idea is that the market will eventually recognize the company's true value, leading to substantial returns. Value investing requires patience and a good understanding of company fundamentals. Investing in stocks isn't just about making quick money, it's about securing your financial future. So whether you're saving for retirement, a down payment on a house, or your child's education, investing in stocks is a powerful tool to help you achieve your financial goals. When we talk about investing in stocks, one name often comes to mind: Warren Buffett. From a humble beginning, Buffett carved a niche for himself in the world of investing. Born in Omaha, Nebraska, he showed an early inclination towards finance and investment, which later shaped his career and his philosophy towards stock investing. Buffett's journey to becoming one of the most successful investors in the world is a testament to his unique approach to value investing. Unlike many investors who are swayed by the stock market's twists and turns, Buffett takes a different path. He dismisses the efficient market hypothesis, a theory that suggests that stocks always trade at their fair value, making it tough for investors to buy undervalued stocks or sell them at inflated prices. Instead, Buffett places his trust in the market's eventual recognition of quality stocks that have been undervalued for a time. He looks at the overall potential of a company, not just its stock price. This approach is rooted in his belief that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. Buffett's focus is not on the intricacies of the stock market's supply and demand, but on a company's capacity to generate earnings. He doesn't merely seek capital gain through holding stocks for the long term. He desires ownership in quality companies that show a strong potential for generating earnings. For Buffett, whether the market will eventually recognize a company's worth is secondary. His primary concern is how well that company can make money as a business. Warren Buffett's life is not just about amassing wealth, it's also about investing in oneself. He emphasizes making prudent financial choices and enhancing one's knowledge in areas of interest. This principle applies to his approach to investing, as he continuously educates himself about the companies he invests in and the industry they operate in. Buffett's success story shows us that with the right approach and mindset, investing in stocks can lead to incredible financial success. So, what can we learn from Warren Buffett's approach to investing in stocks? Well, over the years, Buffett has generously shared his philosophies through some outstanding and thought-provoking investment tips. Let's delve into some of these key pieces of advice. Buffett's first tip is to wait, then pounce. He encourages us to take a breather and step back when we find a company in which we're eager to invest. He advises giving the stock time to reach a reasonable valuation, then making your move when the market corrects itself. This reflects his value-oriented approach, as he's always on the lookout for undervalued stocks that have the potential to rise in the future. His second piece of advice is to stay the course. So you've waited, and now it's time to make your move. But wait, the stock prices have faltered. What do you do? According to Buffett, you hold your ground. You resist the urge to panic and sell. Instead, you buy more. Just keep buying, he said in a CNBC interview. American business is going to do fine over time, so you know the investment universe is going to do very well. This reflects his long-term investment perspective, focusing on the potential of American businesses in the long haul. His third tip is to pick businesses, not stocks. Buffett reminds us to always weigh and analyze the business behind a stock. Try to focus on businesses you understand and have some knowledge of. This will help you assess where a company is heading, not just where it's been and where it is at present. He famously passed on Google and Amazon because he admitted he didn't possess firm knowledge of the internet industry, making it difficult for him to analyze their stocks. This tip underscores the importance of understanding the business you're investing in, giving you a clearer picture of its potential. This piece of advice goes hand in hand with having patience. Buffett encourages us to educate ourselves if we spot an interesting opportunity in a field that we're not entirely familiar with. Analyze the balance sheets, take time to learn. He advises that we should plan to own a stock for at least 10 years, if not longer, bearing in mind that a business will have time to evolve. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes, he said in his 1996 letter to Berkshire Hathaway shareholders. These tips reflect Buffett's long-term, value-oriented approach to investing. He focuses on the potential of businesses, not just their current stock prices. He waits for the right moment to invest, stays the course, and continually invests in businesses he understands. By following Buffett's advice, we can make more informed and potentially successful investment decisions. Through understanding the business, having patience, and investing for the long term, we can approach investing with a sharper perspective and a stronger sense of direction. Now let's delve deeper into Buffett's methodology for finding low-priced value stocks. Warren Buffett, a name synonymous with smart investing, follows a series of thoughtful steps while evaluating a stock. He doesn't just look at the price of a stock. Instead, he pays close attention to the relationship between a stock's level of excellence and its price. This approach helps him identify those hidden gems in the market, the low-priced value stocks that have the potential to offer significant returns over time. When Buffett evaluates a stock, he asks himself several key questions. First, he considers the company's overall quality. He looks at its track record, its management, its competitive advantage, and its financial health. He wants to understand if the company is solid and stable, if it has a strong position in its market, and if it is likely to maintain or improve its status in the future. Next, he thinks about the company's earnings. He wants a business that can generate consistent and growing earnings. He's not interested in one-hit wonders or companies that have a good year followed by a bad one. Buffett seeks out companies that have a strong ability to generate profits year after year. Then, Buffett looks at the price. He wants to know if the stock is undervalued. He's not interested in stocks that are already priced high based on their earnings. Instead, he's looking for stocks that are priced low relative to their intrinsic value. This is where his famous quote comes into play: "Price is what you pay, value is what you get." Finally, he considers whether he understands the business. Remember, Buffett is a big believer in investing in what you know. If he can't understand a company's business model, he won't invest in it, no matter how good the numbers may look. By asking himself these questions, Buffett can identify those low-priced value stocks that are likely to provide strong returns in the long run. His methodology is not about quick wins or short-term gains. It's about investing wisely and patiently for the long term. Buffett's methodology is a testament to his strategic, patient, and thoughtful approach to investing in stocks. So what have we learned from our exploration of investing in stocks and Warren Buffett's approach? We've discovered that investing in stocks is not just a game of numbers, but a strategic endeavor that requires patience, knowledge, and a clear vision. Buffett's approach underscores the importance of viewing stocks as businesses, focusing on their long-term potential rather than short-term performance. His wisdom teaches us to wait for the right moment, then pounce, staying the course even when the market falters. Buffett's philosophy of picking businesses, not just stocks, is a reminder that understanding a company's industry, operations, and potential for growth is key. And perhaps most importantly, investing in yourself, in your knowledge and understanding of the markets is paramount to success. Remember, as Buffett once said, if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Investing in stocks might seem daunting, but with the right knowledge and approach, it can be a powerful tool for securing your financial future.